All right, another live video. We appreciate you joining us. Hi, if this is your first time channel, welcome. We make videos that are all things real estate. And in fact, all things Southern California. What it's like to live here, work here, play here, own a home here, certainly invest here in Southern California. We cover Orange County, but we've sold in Orange County, Riverside County, San Bernardino County, Los Angeles County, Riverside County. So I've lived in Ventura County too, but I haven't gone that far to help someone buy or sell a property, but we could do that. So we appreciate you joining us. Hi, my name is Bruce Clark. I'm a licensed real estate agent, been doing this more than 18 years. And so I'd love to have you subscribe to our channel, click the bell for notification, like our videos. It helps with the algorithm, but the liking and the subscribing and clicking the bell for notification next time we go live or post one of our other videos. I think we have something over 80, up to 100 now with live videos and other things. So we'd notify you next time we have a video. So we appreciate you joining us. Today, let's talk about income properties. And we're going to approach it multiple ways. But one of the things, we were just out looking at some duplexes for a client. Prospective client, I should say. They contacted us, thank you, about going to look at some properties for them. So we drove around the areas, and I believe this is very important. We drove around the areas. We took some videos of the area, took some videos of the property. We didn't go inside and take videos. A lot of times when you buy income property, you're subject to inspection, which means you're not going to go into the property because there's tenants. However, once you have an accepted offer, then you can go in, have your inspections, and that's contingency and inspection. And if the property doesn't work out for you, then you can cancel. And the way it works with contingencies and what's called liquidated damages is your initial deposit's not at risk until you remove all your contingencies. There's no one contingency that's more important or more powerful than another. For example, inspection contingency, appraisal contingency, loan contingency, homeowner association documents, that's a contingency. And you have some others, you have natural hazard disclosure, but a lot of times, again, because there's tenants, you're not going to be allowed into a property. However, sometimes you can, but for the most part, no. But we like going to the areas. We look at the areas. We believe that's very important, and I'll come back to why we believe that's very important. We look at the property, and from the outside, it's going to tell us a lot about the owner and the ownership. There's a lot of deferred maintenance. How does that impact you? Let's say you spent $1 million. You bought a duplex, $1.4 million, $1.6 million out here. You're going to buy it. Let's say a fourplex, so 4 units, but you bought. Or you're looking, you like the numbers, you like the net operating income or internal rate of return, whatever you're going to use, cash on cash, all kinds of things, which we'll be talking about. And so what you'll do is one of the things you'll want to do is look at the exterior, because you don't want to buy a property and let's say you spend $1 million on a duplex, so 2 units, and all of a sudden you have to spend $30,000, $40,000 on a new roof, or you had to spend, let's say, an additional $10,000 because there were termites that perhaps weren't disclosed. You didn't see a termite inspection report, which I wouldn't know why you wouldn't, but some people haven't. And now you have to have boards replaced, and you have to have a tent. A tent is called fumigation. So there's all kinds of things. But again, the first thing is taking just a look at the basic numbers. What's the net operating income? My apologies. I have to take a drink. Sorry about that. So net operating income takes into account operating expenses also, and you end up with a number. And it's a pretty simple number, but we like looking at the NOI, or net operating income, first. What we want to find out is how much cash is being generated from the income of the property. So it's going to take into account the income from 4 units. In this case, let's do a fourplex. So you have 4 units. Let's say that 2 of them have laundry facilities inside and 2 don't. So now you might have a common area laundry facility, and that could be an income producer. So you take, let's say you're getting $2,500 a month per unit, so it's $10,000 a month, so $120,000 a year. And let's say you're getting $50 from a month from the laundry, so that's an extra $600. Let's say that you have parking. Let's say that there's one garage, but they have 2 cars, so you can either rent them a space, parking space, or they can park on the street. And sometimes there could be additional parking, but there's multiple ways to do this. So your gross operating income would be, so you have the net and gross. So the gross operating income doesn't take into account expenses, whereas net operating income does. So one of the things you want to look at, you want to look at the maintenance. If you have someone managing the property, that will affect the NOI or net operating income. So all of those things factor in. One of the things that also is going to factor into the NOI, and this is one of the most important metrics that we use when we first start looking at a property. One of the things also is going to factor in is the utilities, water, gas, electric, trash, those things. We prefer properties that have individually metered utilities. So fourplex would have 4 electric meters, 4 gas meters, 4 water meters. Trash typically is consolidated. It's typically, you would pay, for example, waste management. Not every property is going to have individual meters, and we're seeing more and more properties not have individual water meters. So the water meters, the water bill comes in, and then they just split it 4 ways. There's no way to measure. So as a renter, you're depending on others to not use as much water as not use more water than you, and that's a risk. But it's spread out amongst the 4 people. If you're buying commercial property, you have what's called CAM charges, which is common area maintenance charges. That factors in. So you have maintenance of the whole building, plus, oddly enough, they even build in taxes. So the tenants of commercial property are subsidizing the tax payments on the property, and that's something we saw, I don't know, 5-7 years ago. People started adding them to what's called the CAM charges. So that's the commercial, and NOI definitely comes into play also with commercial. You want to know, what's my net operating income? Basically, what's my cash flow? So, but let's come back. So you've got your $120,000 a year income. You've got $600 from laundry, and now you've got to figure out, what are my expenses? So you take all these numbers, you put them into a spreadsheet, or you let us do it for you. So you could do it, and then out pops a number. There's also others like gross rent multiple, what's called cap rate, and all those are good, quick numbers to come up with, and they're all mathematical formulas. One of the things that we recommend, in fact, I think I'll link to a couple sites that have really good online calculators. Calculated Industries has an app, and we have their qualifier plus 3x calculator. It lets us do NOIs and future market values and future present value, all kinds of cool things, internal rate of return. So at the end of the day, I mean, you really want to have a calculator or a spreadsheet that can do all this for you, and there's multiple out there. Some can get very expensive. I think that cost $80. I think the app was $40 to $50. But all kinds of cool things. There's also flip calculators. If you're looking to flip a property, you can throw some numbers in. Anyway, really cool stuff. But these are things that we're looking at. So we want to first we go, what's the property look like? Does it look like there's a lot of deferred maintenance? Do we see water damage? Do we note water damage? I'm not an inspector. most of my clients are not inspectors, most of my buyers, sellers. However, we just want to do some basic observation, and that is water damage. And do we note anything on the exterior? And again, you can't just walk on the property and walk around. You certainly want to get the permission of the agent. But that's something that if we can do it quietly, surreptitiously, we like doing that, and that lets us get, again, just a basic handle on the maintenance of the property. We look for water damage. That's one of the worst things that we see, because water damage can also then it can weaken the boards. Certainly weaken internal. You could have floor damage. You could have foundation damage. Big deal. You could have mildew. You could have mold. All that's big. Certainly when it comes to buying a property, you want to buy a property that doesn't have those things. You as a buyer have the right to have your inspections. You can have not just a regular, quote unquote, regular inspection, but there's also what's called phase inspections. And we typically, and rarely, in fact, ever get involved phase 2, phase 3, phase 4 inspections. Those can go environmental. They can go really deep, very expensive. I think phase 4 can run you $2,000 and up. I mean, you could spend $20,000, $30,000 if you're looking at buying a big building. You could do geological survey. I mean, you could do an inspection, all kinds of things. The higher phases typically come into play when you're dealing with, for example, restaurants and laundromats and things like that. But let's come back. Let's say that we just have a normal, quote unquote, normal inspection. They're going to inspect they're going to inspect everything. They're going to inspect the electrical, the plumbing. They're going to take a look at the roof. It's not a separate roof inspection. It's not a separate roof inspection. You can get a roofer out to do that. Sometimes you want to. Certainly up to you. Every inspection costs money, but a good home inspector, or even an income so a good home inspector typically will also inspect income properties. And if it's big, let's say you're looking at 12 units, you probably would have 2 to 3 inspectors. We've had that on some of the properties. I think we had 4 on one. So 10,000 plus square foot home, but you get multiple people. So they have drones and they fly, and drones are cool. They get the drones up there and they'll look at the roof. So you want to find out the condition of the property. You as a buyer have the right to have all those inspections. You can have the basic inspection. You could have a roof inspection. You could do radon testing. You could have mold testing if you want. You can do all kinds of things. Whether or not you want to is up to you, but you have the legal right. You also have the right to access the property. And again, keep in mind that in California, you can't just go into a property. Even if you're the owner, you can't just go into a property, knock on someone's door and go inside. You need 24 hours notice, and that's a state law. So, I'm not an attorney, not an accountant, not a financial advisor. Used to be a stockbroker many years ago, but we certainly recommend you consult with your appropriate advisors on all matters. Now, let's come back to the investing side. So you like the property, it's $1 million, again, $1.6 million, for example. We're looking right now to fourplex that we really like. We've been looking at this deal for about a month. Really a good deal in Anaheim, we believe. We've put together numbers and they have good. We think that the net operating income, and we're not looking at the IRR as much because that's more of a. And then we have the cash and cash IRR. We can. It's cash and cash, not as much unless you're actually cash, and there's some things there, but we're looking at the numbers and we really like the future value. We love the appreciation potential. And everybody has a different tax situation. So certainly, again, consult with your tax advisors, because there are going to be taxes in a property. You have depreciation you can take. So you've got tax benefits from multiple ways. Depreciation is really big. You can really goose up your numbers, so to speak, by having depreciation. But you also have recapture of depreciation. So pay attention to those things. But that's where flipping, and now you're talking about long-term capital gains, you have short-term capital gains, and all of those things factor in to the decision you're going to make. We would love to interface with your accountants and any of your if you any of your other advisors. Let's say you have an attorney and you want to put it in an LLC. Again, we can work with them and help you get the best structure for you, you and your family. So that's something that we do. But you like the property, the numbers look good, and you decide to make the purchase. So you get the inspections. If it doesn't appraise, and you have an appraisal contingency, or your loan doesn't go through, as long as you haven't removed all of your contingencies, liquidated damages does not apply, and that means your initial deposit's not at risk. Typically, it's 17 days. We've got shorter contingency periods right now because of the market. Certainly in residential, it's not a big deal to have 7-day for a lot of things. Loan, we like a little longer, but if you've gone in pre-approved and you've already been underwritten and you have what's called a desktop underwriting, a DU approval, then 7 days should be fine. But we'll work with you on that. Short sales, a lot different. Reach out to us. We've got a lot of experience with short sales, bank-owned properties, things like that. So, but let's come back. So you like the property, you proceed, everything goes well. But then, of course, you close the property, you take ownership. Now, one of the questions that people have is, should I manage the property myself? There are professional managers out there, professional property managers. It's not something we do. We're looking at getting into it. It's an interesting field, but there's so many things that come into play. One of the things you'll want to do also is familiarize yourself with the Tenant Protection Act of 2019, because in California we have rent control, and that really is what the Tenant Protection Act is. Now, some cities have additional restrictions. For example, Santa Ana has a maximum 3% increase in rental rates, so that's your rent control. It's 3%. Now, right now we have inflation of 5%. So if you can only increase your prices 3%, but your expenses go up more, then that's a sum loss, not a sum gain. And but if you look at, let's say that in California, so overall, accepting citywide or even community-wide rent control, and I'll come back to that in a second, then you can go up to a maximum of 10%. So it's 5% plus basically the CPI. And there's a formula for that. I think we'll link to the Tenant Protection Act of 2019, because they've also amended it. It's important both as a tenant to understand it, and as a landlord, certainly you need to understand it, because you cannot raise the rents 20%. It's just, now there are exceptions. There's exceptions to everything. Read the Tenant Protection Act, and I'll have a link to it so you see that. But that's important. Now, someone who's buying a property, they have the ability to raise the rent. However, buying a property, you have to adhere to the existing contract with the tenants. You'll want to get what's called an Estoppel Certificate, and that's a certificate. It's a legal document that you'll want all the tenants to sign, so you know exactly. The seller's saying, hey, these people, they're month to month, no worries. You can buy it, you give them a 30-day notice, or you can ask the seller to do that and have to vacate. That might not be the case. That's where you get what's called an Estoppel Certificate. You want to find out, what's the contract say? What's the length of the contract? What's the rate? So terms and conditions. Also, you want to make certain that you get the initial deposits, because the security deposits. And most every apartment owner, of course, every apartment comes with a security deposit. So you want to make certain that you get that it inures to you. So there are things that you want to pay attention to when buying income property. But the first thing is location. And all the numbers, as you're looking, you'll want to take into account, for example, appreciation. What's going to be your appreciation rate? What's the historical appreciation rate? You'll want to use that. You want to plug that in your spreadsheet. We can do that for you. So you also want to plug in expected costs. you're going to have costs. You're going to have whether you're going to have maintenance costs, you're going to have legal costs, you're going to have accounting costs. You're going to have those costs. It could be that you want to build in. Let's say that every 7 years you want to replace the dishwasher in all the units. You can just build that into your spreadsheet. You can do that. Now, you're not going to do it as much with certain formulas, but certainly with the NOI, and you can do that. Just extrapolate that out for the number of years. Years ago, I was selling a 7-unit apartment building in the Ocean Park area of Santa Monica, and they had special restrictions. And this is the way Santa Monica worked. Now they had rent control in the Ocean Park District, but Santa Monica had special restrictions, and it worked this way: you could not upgrade a unit individually; you had to upgrade them all. So the owner took me into one of the units, and it had a really old stove, and it needed upgrading. And he knew it needed upgrading, but he couldn't upgrade that property without upgrading all the other 6 units, which didn't need a new stove or a new dishwasher. Those were fine. But if he did one, he had to do them all. So it really disincentivized the owner from upgrading that one unit that needed upgrading. And that was too bad. And also he was limited by how much he could raise the rent. So if he put $10,000 of upgrades into that unit, question was, could he get that $10,000 back over a reasonable amount of time? And he didn't believe he could, so he didn't make those upgrades. But that's a rent control issue. That was a city, but the state of California Tenant Protection Act certainly we'll look at that. But we enjoy working with investors. We work with investors on all kinds of different levels. Duplexes, fourplexes. We've walked apartment buildings. We've walked warehouses. There's some self-storage facilities out there that are good investments. Assisted living facilities are interesting. COVID really knocked that whole sector for a loop. But the basic numbers: net operating income, you have your internal rate of return, you have cash on cash return, and they're very consistent all throughout. Again, your situation, it's individual. You want to figure out your appetite for risk. One of the things that some of these formulas don't take into account is opportunity costs. And they also don't take into account risk. But that's something you want to factor in. Traditionally, the higher the risk, the higher the reward. So that's something, again, you'll have to figure out for yourself, your appetite. We have some people that are willing to take bigger risks, potentially bigger rewards, and some just love hitting singles. $10, $15, $20,000 here and there is great. Others say, hey, let's swing for the fences and let's see if we can get a 18, 20, 30% return a certain amount of time, which could be theoretically millions. So, but it's very interesting. I also want to talk about, for a second, let's talk about the economy. Stock market's been doing well. Earnings, retail, interestingly, doing well. But here's what we're seeing. Default on credit cards dramatically increasing. We're seeing a doubling from just the past year in some age groups. We're $17 trillion in debt, so that's interesting. When you buy a home, or when you buy anything, any properties, you have what's called debt to income ratio. They're going to come in, they're going to look at your DTI. And so what's your debt load? It's easy, it creeps up easily. You buy a car, you went on a trip, you threw it in the car, you didn't pay down after Christmas or Eid or after Hanukkah. You say Hanukkah, it's Hanukkah. And so all of a sudden your bills are going up. Keep in mind the credit card companies are increasing rates. Certainly as the economy, who knows where we're going economically, but I want to throw that out. The real estate market, we're still very active. There's just not enough inventory. We've got offers out on properties, and it's tough right now. People are willing to, again, just like during COVID, people are willing to pay more for a property than it's going to appraise for, and that's a tough one because the appraisal, all things being equal, appraisals are subjective. So they're not objective; they are subjective. And so, because the inspector's going to come, they're going to look at, the appraiser's going to come. They're going to do a comparison with other properties. They're going to look at that property, and there's things about the property they might not like. The buyer might love it, the buyers, but the appraiser might ding it because of a few things. And interestingly enough, the buyers might see that as a net. For the lender, they might not like certain things. So, but we're still seeing properties sell for over asking. It's an interesting market. We're at 25 minutes. I appreciate you joining us. Thank you. Enjoy, and I pray you have a wonderful evening. So whether you're looking to make a move in the next 5 days, 50 days further out, give us a call, shoot us a text, send us an email. We'd love to help you make a smooth move to Southern California. Orange County, that's where we're based. We do a lot of business here. Whether you're looking to buy, sell a home, an income property, commercial, reach out to us. We'd love to work with you.